I'm in my 40s. I have 300 grand in my 401k retirement account, and I have 23 years left on my mortgage with a $254,000 balance and only a 3.25% interest rate. And I have 400,000 in equity in the house. Sounds pretty good, right? Except there's a problem. I have $145,000 in debt between low rate credit cards and a HELOC loan. You know, this is a situation I think a lot of people find themselves in these days. Like on paper, on the surface, it looks like you're doing good because you own a house, you have a lot of equity, you got some money saved up for retirement, but you couldn't resist living beyond your means, and now you're stuck with 145 grand in debt, and some of it is tied to your house, which is always the worst case scenario because that means the only way to get out of it is to either sell your house or to refinance your debt. So this is one of those stories that, people write in, they ask the professional financial advisors, what should I do now that I found myself in this situation? So I want to read the answer to this question, whatever this financial advisor answered this person, and kind of give my 2 cents along the way. Now, first of all, let's start off by saying that no matter what this guy does, it's not really going to be a good choice because he's asking, well, if you were in my shoes, what would you do? Would you rather refinance and get a 6.7% mortgage rate and pay off the credit card debt and home equity loan, or get a HELOC, or downsize your home, meaning you have to sell the house and buy a much smaller and cheaper house? So in case you can't tell, 2 out of these 3 options involve going into deeper debt to pay off debt, essentially trying to dig your way out of a hole, which never works. Now, I like this financial advisor because he gives the advice that you're probably better off downsizing and getting rid of your debt entirely and getting your financial life back into the black, meaning that you are completely out of debt except for your mortgage. And the other thing that's good about the downsizing option is that he won't have to touch his 401k and have any penalties against reaching into his retirement funds. But the one thing that this guy says that I really like, that kind of resonates with me and kind of mirrors what I talk about here on the channel, is that you should be taking a hard look in the mirror at how you got $145,000 into debt to begin with, and rather than beat yourself up over it, figure out how you can prevent it from happening again. Because if it wasn't for that $145,000 in debt, this guy would be in very good financial shape and wouldn't have to potentially get rid of such a great home that he owns with so much equity and a very low interest rate. That's what's called the golden handcuffs, and a lot of people are not selling those homes because they can't find a better deal anywhere these days. But some people are being forced to sell who are in bad financial shape otherwise, like this person. And that's why you've likely seen the refinancing activity on the mortgage market be much higher than the purchase market. Because even though the rate situation is not ideal, even if you have a good rate, you might have to refinance in order to pay off some of your debt and continue living above your means. And unfortunately, that's the option a lot of people choose rather than sell the house and downsize and kind of hit the reset button. And for anybody who's wondering, I'm walking down Birch Avenue in Corte Madera today. But the idea here is that if this guy were to downsize, he would be taking on a 6.7% mortgage rate, assuming he has perfect credit. But it also is assuming that you're going to buy a significantly less expensive home than you own right now. And that is something a lot of people struggle with doing, especially if you're in your mid 40s, you're not, anywhere near retirement age yet. You still have to work. You likely might even have a family. So downsizing might be impossible if you have kids. And that's how a lot of people back themselves into this corner that there's no easy way out of. And a lot of people just choose the option to try to dig their way out of a hole that they're already in by refinancing their current mortgage or getting that HELOC to pay off another HELOC, to pay off credit card loans. Like, how does it make sense to go deeper into debt to pay off debt? Answer that to me, guys. Anybody who has a good answer to that question, let me know. Obviously, the United States government seems to think that's the way to financial freedom, which clearly it's not, but that's how we run this country. So it's no wonder that's how so many Americans run their financial life. And yes, you could take those other options. You could refinance your house and explode your mortgage payment, or you could take the HELOC and have an additional payment on your house. But those are pretty foolish moves to make for short-term satisfaction, because yes, you're going to pay off that debt. However, you're not going to learn any lessons from what you've done. You're kind of just getting a free pass, so to speak. And the only pain you're going to be feeling is the increased monthly cost that you're going to have now that you refinance your home or have an additional HELOC to pay off all this debt. But a lot of people are okay with that trade-off, and it's how they get into such deep financial trouble, because it's like, well, even if it's difficult to make those increased payments, I'm not going to worry about it, because I'm just going to continue tapping the equity in my house until there's no more equity left to tap. That's what a lot of people end up doing over the years. They refinance their house several times, every time they're able to pull a substantial amount of equity out, and that's how they're able to finance their lifestyle. This is probably one of the worst ways that you can live your life in terms of financials, and it always comes back to bite people in the end. And just to put it in perspective, this guy says he has an $1,100 a month mortgage payment right now. If he were to refinance his house and add in that extra $145,000 in debt, plus closing fees, things like that, his payment's going to go from $1,100 a month to $2,600 a month, which I would be assuming is not probably manageable, and he might not even qualify for that. That's the other thing. Sometimes people think that they can just kind of refinance their way out of these financial troubles, only to come to find out later on that they don't qualify for the refinance, because when you refinance your home, you have to have the income to back up that new payment. And if you don't, you're going to be denied. And taking the HELOC is not a much better option, because if he were to do that and get a HELOC at 8%, that would give him an additional $1,300 monthly payment just on the HELOC. So now you have the $1,100 mortgage payment plus the $1,300 HELOC, so you're at $2,400 a month, slightly cheaper than refinancing, but not a whole lot better. So hopefully this guy will take the financial advisor's advice and sell his house, pay off his debt, figure out how to make sure that never happens again, get himself into a cheaper, more affordable home, and still have a low mortgage payment, even though he's going to have a higher interest rate, and move on. That's probably going to be the best, smartest financial move. Whether or not this guy's actually going to do that, who knows? But it's interesting to note that even people who appear to be doing well financially and do have some choices available, who are not just completely broke, sometimes back themselves into a corner where, even though they have options, none of them are really good. And that's just another lesson of why you need to live below your means. You always need to be saving and investing for that rainy day, just like the video the other day we talked about, where you can lose your job and you can be out of work for a couple years and be trying to scrape by on gig work with a stay-at-home wife. That's not going to be fun either. And let's face it, guys, owning a house is no walk in the park financially. It's a large financial commitment. The average amount of money that US homeowners are sinking into their home right now, in addition to their monthly mortgage payments, is about $21,000 a year. Some estimates range between $20,000 and $24,000, but either way, that's a lot of money. And if you've never seen the Money Pit movie, I highly recommend you go and watch it, because it is a really funny movie, first of all. But anybody who's buying a house, this should be like a prerequisite for anybody who's considering buying a home to go and watch the Money Pit movie, because there's so much truth in that movie besides the comedy aspect, like the contractors that don't show up on time and the amount of work that they need to do on the house goes way over budget, and literally needing to sink every penny that they have into this house just to get it renovated. And in the end, well, I won't spoil it, but it's kind of all for nothing. And that doesn't mean that buying a house is always a waste of money or that no one should ever own a home. That's not what I'm saying. I'm just saying that under the current circumstances right now, buying a house is probably going to get you into a money pit situation, because you got to pay top dollar for the house. You're going to pay high financing costs, and you're going to pay higher than ever upkeep, maintenance, and insurance costs, which is where this extra $21,000 a year comes from. And the problem is, a lot of new homeowners do not factor in these additional expenses when they decide to buy a house. They just look at their monthly payment that the mortgage broker is giving them and say, oh, that's good, I can afford that, not thinking they might have to put an extra 20 or 30K a year into that house that's not on that mortgage payment. Between 2021 and 2024, homeowners insurance costs have gone up about 24%. In some places, it's gone up over 100%. Right now, it comes in at an average of about $2,300 a year. And a lot of times these homeowners insurance companies are just raising the prices just because they can, and they need to cover their major losses that they've had in other parts of the country, even if you live in an area that hasn't seen any real problems for a while. Then you're going to have your utility costs, and depending on the size of your house or where your house is located, whether you have a pool, whether or not you like to keep a nice garden or lawn, these are all going to have major impacts on your utility costs as well. Because now all of a sudden you're getting a gas bill if you have gas, you're getting a water bill no matter where you live, and you're getting an electric bill every month unless you have solar that is paying for most of your energy, but that can actually backfire as well, like we talked about in an earlier video. According to a Bankrate study, it found out that the average American homeowner pays about $4,500 per year in just utility bills. And if you include cable and internet, that number goes up by an additional $1,500 per year. Now, I know most of us are living without cable these days, but no one's living without internet. Otherwise, you wouldn't be watching this video right now. Some people are able to get by just having their cell phone LTE or 5G plan and not actually having home internet. If you're a very light internet user, that could work for you. So you don't have an internet bill, but you're still paying for the phone. Now, of course, with insurance, you can shop around and try to get a better deal somewhere else, which is possible, but not too likely, but it does happen. And with utilities, you can also call in and ask them to give you a better deal or threaten to cancel. Sometimes that works. They'll send you over to the retention department and give you one of those promotional rates, something like that. It's not a guarantee, but it's worth a try. But then the big one that people forget about is maintenance and repairs. The average homeowner is spending almost $9,000 per year on maintenance on their property every single year. So as you can tell, just from the maintenance and utilities alone, you're already at a 5-figure bill each year for the house. And guess what? If your house was built before 1980, this number could be significantly higher because of all of the upgrades that your house might need. Plumbing, electrical, foundation work, whatever. Because there's data that suggests that if your house was built before 1980, that in 2023, homeowners spent 76% more on maintenance than homes that were newer than 1980. And this is why I'm constantly telling people these days, you need to be aware of what these expenses are before you jump into just owning a house these days. If you're renting right now and you have a good deal and you can't find a house for sale that's going to have a lower monthly payment than what your rent is right now, you're going to be increasing your monthly housing expenses significantly by becoming a homeowner. Even if you find something, let's say $200 a month cheaper to own than to rent, once you throw in all these additional expenses, it is not going to be cheaper, not even close. And I know it's tempting, especially if you haven't owned a home before, to kind of just look at the monthly payment numbers like, okay, I can get this mortgage for $1,700 a month, or I'm paying $1,900 a month in rent where I live, so it's actually a better deal to buy, right? Well, maybe, depending on all the additional expenses that you really need to look into. In fact, if I were you, I would ask the owner of the current home that you're looking at buying and ask them what their utility bills are. Ask them to give you copies of their electric bill, their water bill, their gas bill, all of this stuff. If they're reasonable, they should have nothing to hide. They should have no reason not to disclose that to you. There's no requirement that they have to give it to you, but if they want to get the house sold, then they shouldn't have any problem forking over that information. Now, when it comes to selling condos these days, the biggest thing holding back a lot of condo sales is the unknown of the future expenses of the condo, mainly special assessments, right? Because special assessments come out of nowhere and they can be extremely expensive. I've shared with you guys several stories of special assessments that are in the hundreds of thousands of dollars that people are getting slapped with in Florida in particular, and don't have a lot of good options to resolve it other than to sell their condo, possibly even for a loss, just because of the size of the special assessment. And even if there are no current special assessments, a lot of buyers are wary about buying a condo because of the future possibility of there being a special assessment. So I just read this story today about this new type of home warranty or insurance, I guess you could say, that covers special assessments to help get condos sold, which is something I've never heard of before, but we're going to tread with caution on this one because, as you saw in my home warranty video the other day, there's a lot of problems with home warranties, and it sounds like this special assessment insurance isn't that different than a home warranty. So you got to make sure you're really understanding what you're getting here. So here's an example of a listing of an old condo in Chicago. Building's kind of poorly managed, hardly have any reserves, and a special assessment was probably going to be on the way soon. So the listing agent included a new warranty program that protects buyers against special assessments for up to 3 years. And she said that actually sealed the deal, and it gave the seller the opportunity to make the buyer a lot more comfortable knowing they wouldn't be on the hook for any forthcoming repair costs. Now, this new product is being offered by a company called HOA Warranty, and right now it's available in 6 states, in Illinois, Indiana, Michigan, North Carolina, Ohio, and Pennsylvania. So probably a lot of the cheaper areas where you don't have these giant special assessments like we have in Florida and like here in California, where the numbers can just be off the charts. But they say they hope to add more states in the coming years. And the owner of the company is hoping that this assessment warranty is going to become a regular part of condo sales, just like home inspections and home warranties are for single-family houses. Now, on the surface, I think it sounds like a good idea, especially if it helps get your home sold, right? But the problem is always the same thing, the fine print, what's actually covered. Also, you can buy in a condo, for example, that has this HOA warranty, but they don't actually levy a special assessment. They just raise the HOA fees by 50 or 100%, which I'm sure this warranty doesn't cover. So it's estimated there are about 369,000 homeowner associations nationwide, and about 70% of them are actually underfunded. So this company actually has a lot of opportunity to expand to many different markets across the country. However, I would be willing to bet that these people are going to be on the hook for not paying a lot of claims that they should have paid. Because just like the home warranty companies, they find different ways to weasel out of different things that are supposed to be covered, or at least people think are covered, only to find out later on that it's either not covered or they're just refusing to cover it because of a technicality, and kind of the only way to fight back as the homeowner is to sue. So right now the prices are as follows. For $380 for 1 year, they will protect your condo against a one-time special assessment up to $10,000. For $600, the protection is extended for 2 years, and for $800, you're covered for 3 years. And it says right here, it should be noted that these policies do not protect buyers against increases in their regular association dues, only special assessments, just like I thought that would be the case. And let's face it, these special assessments can be very expensive, and $10,000 is kind of like nothing for these assessments, guys. So if you get hit with, say, a $40,000 special assessment, even if you have this insurance, it's only going to cover the first 10 grand. The other 30 grand is on you. So you can see this company is not really taking big chances here. And this is definitely kind of a false sense of security for condo buyers. So I didn't actually read this whole thing before I made this video, and now that I'm hearing about it for the first time as well, I don't think this is really enough to push most people over the edge. Like, if this is the defining factor for you to close a deal on a condo, then I think you just got duped, to be honest. The other thing to note is this company is still very small. I think the idea is good, don't get me wrong. I think the idea behind it is very good. I just think that the offer is very weak, especially with the size of special assessments that are out there these days. And the company's still so small that the owner is paying this very first claim of $6,000 out of his own personal savings. So it sounds pretty sketchy right now, in the sense that the company is in its infancy and could easily go bankrupt if they had too many claims come in. So of course he's looking for investors, just like any other company does. That way he can sell more of these home warranties and be able to financially back them with more ease. Honestly, I don't think this thing would even be that valuable in the Florida market, considering the size of the special assessments we have over there. You know, having $10,000 in coverage, frankly, is nothing and isn't going to get you very far if you get a $50,000 or $100,000 special assessment on your condo. And so far, they don't have coverage options for that. But even if they did, right? Think about the home warranty video, guys. If you didn't see that, go back and watch that video I made a couple days ago. But the idea is that even if they say it is covered, let's say you can get coverage up to a $100,000 one-time special assessment for 3 years, even 5 years. Sounds much better than the current offering, right? But then there's all these little clauses and caveats and fine print in the contract that say, but if X, Y, or Z were to happen, then we're not going to cover it, or it's only going to be partially covered, et cetera, et cetera. But I'm sure this guy's going to have some success because just like the home warranty business, a lot of people are sold a home with the home warranty and think that's the best thing since sliced bread. So I'm sure a lot of condo buyers are going to take the bait on this as well. But in case you haven't heard it, you heard it first here on my channel, and you know now this is something else to look out for as somebody who might want to buy a condo in the future, because this could easily be an offering, especially if you're in one of the states that's currently covered with this. And now you know it's not as good of a deal as it sounds, as a selling point that a lot of real estate agents are going to try and make it sound like. Is it better than having nothing? Yes. Is it going to cover everything? Absolutely not. So let me know what you guys think about all this stuff. Would you refinance a house in order to get out of debt and dig yourself deeper into debt? Would you take your losses and get ahead while you can? Would you take one of these condo warranties and think that's going to be enough security for you to move forward with a kind of shady or uncertain deal? Let me know. So if you guys enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.